Before we begin, here's how to earn continuing professional education credit for attending this session. Gain valuable insights by attending the podcast, then complete the assessment test to download your certificate. To do this, follow these simple steps. Click on the link in your description to access the session. Create a free account and attend the podcast. After the podcast, take the assessment test and download your certificate. It's easy, and it's free. We highly recommend checking out our subscription. Let's get started.
So, David, from your
Yeah.
perspective, when you look at a purchase agreement in one of these deals, what's the single biggest misconception you see sellers walk into?
The single biggest misconception,
Or maybe that would be
when
too
it,
broad, whatever.
no. I mean, I think single biggest is hard to say, but when it comes to, in particular, going back to Mitchell's point, any kind of contingent piece of the consideration of the deal.
Yeah.
Oftentimes sellers will be wooed by the buyer,
Yeah.
and they'll think the buyer is their friend.
That actually is very, we see that all the time when there's post-closing disagreements and when things go wrong. It always, as David mentioned, when they're going through the process and being wooed, they have their quote unquote champion, right? Well, this person, this VP in Corp Dev, really likes us and he's our biggest champion with the board, with the CEO, whoever. Once the deal's closed, that person could have moved on.
Yeah.
And when the relationship, when it not inevitably, but if it sours, the first thing our clients come back to us and tell us is, well, our biggest champion, was so and so, and he's no longer with the company, and so we're kind of adrift in this large conglomerate.
Welcome everyone to another episode of Accounting M&A Insider. If you are thinking about selling your accounting firm or even just exploring your options, this episode is required listening. Most CPA firm owners spend months focused on one thing, the multiple. What's my firm worth? How do I get the best number? But today's guests are going to tell you something that might surprise you. The multiple is almost the least important part of the deal. What you sign, how you structure it, and what you agree to post-close. That's where money is made or lost. I got two sharp attorneys with me today, Mithil Makadia and David Siegel, and we are going deep on the legal playbook of selling firms. Mithil, David, welcome to the show.
Thank you.
Thank you for
Thanks for having us.
Yeah, thank you for having us.
Absolutely. Now, I want our listeners to know who they are learning from today. So Mithil, let's start with you. Give us your elevator pitch of your background and how you ended up in this world.
Sure. My background and the firm's background are very intertwined. So I've been practicing over 20 years in general corporate and M&A, and I've been with Grella Shaw for the last 15 years. And we represent predominantly founders and early stage startups and sellers in M&A deals. And so I do a ton of VC funding rounds and M&A deals, and I've been doing this for a very long time. We are a boutique firm in Silicon Valley, but we have clients all over the world. So that's a little bit of a background on me.
Brilliant. Couldn't have done it better. So you're really in the trenches with the founders. And
We are. And in terms of our clients, they're really mid-market in
yeah.
valuation. Yeah.
Well, you mentioned that, you're in the trenches with the founders, and honestly, I think CPA firm owners are the founders, right? They build something from scratch. So, I'm glad that you're here. And David, same question to you. And I'll be honest, before you get on, I'm curious because your background is a little unusual because you've done both transactional work and litigation. So
Yeah,
tell me all
I
about
came
it.
at this from a different starting place. I started my career at a large international law firm,
Yeah.
doing pure litigation. A lot of it IP litigation, but kind of a broad range of litigation. And when I came to Gorilla Shaw about 15 years ago, I started to transition my practice over to the corporate side. I still dabble in the litigation side, but that's not where my heart is.
Yeah.
My corporate practice is largely what Mitchell's practice is. Representing early mid-stage companies and doing M&A work as well. My litigation mindset does play in, and I think is an asset in deals to try to explain, practical ramifications of things that clients are being asked to agree to. But it does give me a different mindset.
Well, and that's why you're here. Because
Yeah.
honestly speaking, I mean, in fact, for that matter, both of you, because litigation depth is actually going to come up a lot today. Because when we talk about what happens after a deal closes,
Yeah.
knowing how these agreements hold up in dispute changes, the way you read them, so dispute it can really change. So, I'll definitely be, like we'll be talking about it. Now, I want to start about the legal structure and why that matters more than the multiple, because I think it's the biggest mindset shift for firm owners and everyone, and I mean everyone who comes to the table are obsessed with valuation. They always ask, what's my multiple? Am I getting a 5x, 8x? But we know that structure often matters more than price. So Mithil, let's unpack that. How can two deals at the exact same headline number produce totally different outcomes for the seller?
Well, normally I would start with tax, but I'm going to put that aside given this audience because I think tax is one thing that they would understand. So I'm not gonna go into that one. But
Yeah.
the thing to understand is that multiple, that top number, how much of that is actually guaranteed, and how much of that is at risk because of the deal terms. So how much of that is money that you're actually going to get? And then the counterpart to that is how much of that is money that you get to keep? What is at risk for a clawback? And so that's what you need to think about from a legal perspective. The top line number is great, but we've been on the buyer side of deals as well. And the first thing we ask our clients with the top line number is, do you actually expect to give this number? Right? Then that based on that is how we structure the term sheet. So you have to put yourself in the buyer's mindset. How much are they actually going to give us and how much can we keep? So that's the broad strokes. Getting into the details, it's how is this deal actually structured, right? Is there an earnout? Is there risk of clawback? What's the indemnification obligations? Those are all things that go into a term sheet and you need to review very, very carefully. I know sometimes clients will say, oh, well, this is a non-binding term sheet. I really need to get the buy. The buyer's motivated, they're excited. I don't want to lose momentum. Let's just sign this. We'll deal with the details later. That is not advisable at all. Your leverage, I always tell sellers, your leverage immediately plummets as soon as you sign that term sheet. So even if it's non-binding, get all the things you want ironed out before you sign that term sheet.
Yeah. That term non-binding, it's it's so confusing for a lot of people. I actually even did a podcast in the past wherein this gentleman also cleared that out, that just because it says non-binding does not mean that you can just sign through it. But from what I hear, what you're saying is the number on the term sheet isn't what really goes into the pocket, because there can be different deal structures, and that's what you got to be careful about, right? So David, from your
Yeah.
perspective, when you look at a purchase agreement in one of these deals, what's the single biggest misconception you see sellers walk into?
The single biggest misconception
Or maybe that would be
when
too
it
broad, whatever.
no. I mean, I think single biggest is hard to say, but when it comes to, in particular, going back to Mitchell's point, any kind of contingent piece of the consideration of the deal.
Yeah.
Oftentimes, sellers will be wooed by the buyer.
Yeah.
And they'll think the buyer is their friend. And I think you had mentioned earlier, and this might have been when we were just talking before, that for a seller, this is often the only time they'll go through this process.
True.
For a
True.
buyer, there are exceptions to every rule, but oftentimes they go through this process all the time. And
Right.
they have negotiation playbooks in place. And one of the common playbooks is I'm going to woo the seller and I'm going to make them feel like they're important and they're key to the future of this combined entity, or depending on what the structure is, exactly what it is. And what sellers will often feel inclined to do is take the buyer at their word that they'll, the legal language is not what's important. The spirit is what's important. And let me tell you, that is not true. And it's not because buyers are liars or fraudulent. That's not really what it is.
Yeah.
It's just that the people who are negotiating principal to principal are not the lawyers. And the people who will be evaluating things post-closing are none of these people. It's a whole different set of people who don't see necessarily your value to the future or see things very differently. So it's really important in the end to put aside what seems like the bond you formed with whoever it is on the buyer side that you as a principal are dealing with. And remember that the legal language really does hold and will govern.
That actually is very, we see that all the time when there's post-closing disagreements and when things go wrong. It always, as David mentioned, when they're going through the process and being wooed, they have their quote unquote champion, right? Well, this person, this VP in Corp Dev, really likes us and he's our biggest champion with the board, with the CEO, whoever. Once the deal's closed, that person could have moved on.
Yeah.
And when the relationship, when an event, not inevitably, but if it sours, the first thing our clients come back to us and tell us is, well, our biggest champion, was so and so, and he's no longer with the company, and so we're kind of adrift in this large conglomerate. So.
Yeah, I mean, I can't stress enough. I've also had people, because once this thing has happened, it's gone to the legal stage when the dispute has happened. They remember those words like LOI is just a formality. The real deal would happen later. But that's the important thing, because the LOI is not a deal, but at the end of the day, it is important. And I'm going to ask you this question because this is something that I cannot stress enough. Everybody listening into this podcast needs to know. So I want to hear it from you, because your experience. At what point in the process should a seller bring in a legal counsel?
Yes, I definitely have thoughts on this one. And I was just telling a client, a prospective client, this yesterday. So I immediately from the beginning, as soon as before even a term sheet is signed, sometimes there's terms that are, just a couple of bullet points that are either texted back and forth between the seller and the CEO or emailed back and forth. And then once there's an agreement, then they give it to their legal team to prepare a term sheet. At that time, you want to get us involved, but you don't want to tell the buyer that you're getting your lawyers involved. I like to stay in the background. I like to tell clients, sellers, take the deal as far as you can take it in terms of negotiation, get the economic terms, push them, negotiate, go back and forth, take it as far as you can take it, especially things that you care about, which is your top line number, your salary. Sometimes founders care about the salary, your stock, equity, whatever the terms are. Once that's done, then say, okay, but I need to run this by counsel. And then let us take a second bite at the apple. Then let us go in and actually revise the term sheet and redline it. Because if we do it all at once, if you're still negotiating the numbers and we're marking up the term sheet, there's a lot of horse trading that happens. We don't want to do that. We want to take 2 bites at the negotiation, at the apple. And so definitely get us involved, but keep us in the background until you're happy with the overall number, and then let us negotiate the term sheet. But don't do what some clients do, which is come to us after you've signed a term sheet. That happens, I would say, what,
Yeah,
15%
that
of the time?
Yeah,
10,
that it
15% of the time
happens
that
more
happens?
often than it should, and
Definitely. Yeah.
it
yeah.
does create issues. The other thing I was going to riff off of that Mitchell said is the other thing that makes it important to try to negotiate directly the economics of the deal before marking up an LOI or term sheet and getting into the weeds of that is if you're doing those all at the same time, you're signaling to the buyer that you're bought into the process a little bit too much. If you're negotiating over what will be perceived as we don't think they're small things, but what will clearly be perceived as the small things when you haven't settled on a number, they know you're going to move forward with this deal.
Yeah.
Yeah, they've
Yeah.
got you.
They've got you at that point. So what you want to signal is I'm not getting into the details until the economics are something that I'm interested in.
And it's a little psychological too, right?
Yeah. Yeah.
Once sellers, if you've been toiling away at your company 12-hour days for, 6 to 15 years, I don't know what the normal trajectory is, for a while, then
Yeah.
as soon as you start sort of coming to an agreement on a sale or a top line number, you start spending that money in your head already, and you start counting the end of your 12-hour days.
Yeah.
And it's really psychologically very, very hard to
True.
pull
True.
yourself back from that and go back to your day job. Yeah.
Absolutely.
So
Couldn't agree more. In fact, this is not related to the podcast, but when I had started in corporate development, I came from a different, I mean, I knew how to serve clients, but that's a different case. Corporate development is a lot different. And, you know, my my mentor, he asked me that, do you play poker? And I'm like, no, I'm not a gambling man. I don't even I don't even know how it works. I'm like, you need to learn how to play poker. All right. So, and I was like,
yeah.
I had no reason. I didn't understand it well, but eventually I got to know that, you can't open your cards too early. You gotta be very cautious of how you're reacting or saying things. And I guess that's why, need of an advisor, a legal attorney and all that early on is very much necessary because like you rightly said, Mithil, this is a once in a lifetime event for a lot of people, right? And you probably don't know what you're getting into. Whereas buyers, they're probably doing this day in, day out. They have a playbook ready. They know exactly what they need to do. Boom, boom, boom. They know exactly what the responses are
And
going to be.
they know how to read the signals,
Yes.
Yes.
like you said.
Yeah.
Yeah.
Yeah. Now, when we are talking about deals, a lot of people think that, okay, so when I sell my business, technically what's happening is, I have this equity in this business and now somebody else is going to be the owner of that equity and now they own the business. But then there are two things, right? There's the asset sale and then there's
Mm-hmm.
the equity sale. And I think a lot of people may have heard it, and a lot of people may have not, but they don't quite fully understand what is an asset sale versus an equity sale. So Amital, I'm always going to start with you. So can you please break that down to us in plain language? But David, please don't be shy. Obviously,
Oh yeah.
you
Yeah,
can.
no, we work well together. He'll jump in.
Yeah,
So with
yeah,
an asset sale, it's really what it sounds like. The company stays in place. You, as the founder and CEO, can continue to stay founder and CEO of this shell of a company, but you're
right,
essentially selling all of your assets
right.
to the buyer, and in
Hmm.
exchange, the money is, or consideration is going to the company. So the company has to pay taxes on it at the company level. And
Right,
then depending on, we don't want to get too much into tax, but eventually that money gets distributed to the stockholders of the seller entity.
yeah,
With an asset sale, a lot of times buyers will say, we just want the assets, none of the liability, all the liability stays with the seller. We're just taking sometimes all the assets, sometimes some of the key assets. And particularly with contracts, right, that have anti-assignment clauses, all of those need to get transferred over to the buyer entity. So you need to make sure that you have consents to assign all of the assets and all of the contracts. And
nice.
then with a stock sale, you don't have to worry about assignment. because the entity that entered into these contracts stays in place. It's just that the stockholders of the selling entity are literally just selling their stock to the buyer. And so once that stock sale is complete, the company becomes a wholly owned subsidiary of the buyer entity. That one, the sellers will hopefully have long-term capital gains tax on the sale of their stock. And if it's QSBS eligible, great. Maybe that's a better tax savings for you, but generally speaking,
Yeah.
it's a better tax treatment for sellers.
Do you want to earn CPE credit? Take this course of MyCPE 1 to earn free credit. Click the link in the description to get started.
And I may be asking you a question that you may not have an answer to, but private equity backed platforms, right? Buyers, especially the private equity backed platforms. Which is it that they prefer over the other, and why? I mean, I know there could not be a right answer to this, but from whatever you're exposed to, what have you seen to be
Much more often equity
right?
sales of some sort. I mean, there are different structures even of equity sales, but the other thing with private equity is typically they require some core set of people to roll over and their equity into the new entity, or there are other forms of that concept. It's not just one, but normally they're not just giving you money and saying goodbye. It's just not the nature of how private equity deals work. But I don't see nearly as many private equity asset sales.
Interesting. Very, very interesting. In fact, this is something that even I am always curious about. So whenever I come to talk about it, whenever I talk to any advisor, I always ask him this question: what are you seeing more?
Yeah.
And it's so surprising. The other day I was talking to this other guy, and he has seen more asset side deals as compared to
Really?
stock. And I'm like, I mean, look, an accounting firm is not
Yeah.
really asset heavy,
No,
right?
it's not.
It's not. And I'm like, how does that work? But anyway,
Yeah, it's driven by tax a lot of times,
Yeah.
too, right?
yeah,
Unless the company has been operating at losses for a long time and it has a lot of losses it can offset against the gain. An asset sale can just be not a good tax situation for sellers. And
Right.
buyers are generally cooperative with that, and they don't want to force the sellers into a situation that gives them an adverse tax consequence.
right. Now I know that we're not going to be talking specifically about tax, right?
Yeah.
But and obviously we don't want to, because this podcast is not about giving a taxation masterclass. But let's do like a conceptual role play, right? If someone gets 5 million deal as an asset sale versus an equity sale, what could that difference in net proceeds actually look like?
It depends on the structure of the entity that is being entering into the asset sale. But as Mitchell said, if it's an entity that has corporate tax, then first there's the 20 whatever percent corporate tax rate.
Yeah.
And it depends if federal and potentially state. It depends again on where you are.
Yeah.
And then there's the taxation at the shareholder level. So it's two levels there. And then again, so then you have the second issue, which is if it is an entity that has corporate level tax, it's likely the case that there would be the potential for the whole structure to be a tax-free reorg, maybe.
Yeah.
But it's very, very hard to do an asset sale as a tax-free reorg. So on top of that, it's probably not tax efficient. Again, if there are losses, you can take losses. An accounting firm that's being sold probably doesn't have a bunch of NOLs. If we're talking about an accounting firm, it would be unlikely. They wouldn't be a good target for a sale.
They probably aren't C
starting with
corps
losses.
either, though.
What's that?
Yeah.
They probably aren't C corps either.
They probably aren't C corps either. That's true.
True. Very true. In fact, this is something that happened in one of the deals that I was a part of. um, they are a professional corporation in
Yeah.
California, right?
Right.
It's often, a single owner professional corporation,
Yeah.
and that is a problem in itself,
Right.
These are things that you don't really consider, because see, there's buyers that have been doing this day in day out, and then off late what I'm also seeing is people who are not really buyers, they're also first time buyers, and
Right.
like they're just like a larger firm and they just want to acquire a smaller firm just for that matter. So even the buyer is a first time buyer, the seller is also a first time seller, and this is exactly what happened in this deal, that both of them were first time
Yeah.
and they didn't equate this into consideration. I mean, lots of things happened. One is they did not involve a lawyer until the LOI was already signed. It was signed, the LOI was signed, and that's when the lawyers got involved. So
Oh, that happens. It definitely happens.
so
But that's
that
okay because usually when it comes to structure, that kind of structuring,
yeah,
usually the LOI gives some leeway, The actual structure will be determined in a tax
yeah,
efficient manner,
yeah,
when the definitive docs are. So
yeah,
by that time, we've engaged corporate counsel, tax counsel, and that
yeah,
part of it is fixable. So
yeah. Now, of course it is.
in that sense, the non-binding nature of the term sheet does help.
Yeah.
Yeah,
What I find when, when people say, well, it's non-binding, it doesn't matter. It's whenever there's a change to be had that's favorable to the buyer, it will happen, even though the term sheet says otherwise. And whenever it's a change that's favorable to the seller, it won't happen because, well, we've already agreed to this at the term sheet.
Yeah.
So that's what's when you sign a term sheet as a seller, that's what you need to be aware of.
which is why you need to get the lawyers involved
Yeah.
way beforehand. I mean, very classic example. And thank you, Mittal, for bringing that out. Now, we want to go deeper into the actual purchase agreement. We are assuming that the due diligence happened well, or something came out or whatever it may be. But now we are going into the purchase agreement. We're not going to touch due diligence because that's a horrendous topic in itself. We don't want to talk on it. But you know, the purchase agreement, because this is where I think the real risk lives for first time sellers. And you know we're going to go with David first now, because you've seen these so David, you've seen these agreements both as a
Yeah.
deal lawyer as well as a litigator.
Yeah.
So walk us through the representation and warranties, because everybody should know this. What are they and why do they matter so much?
Yeah, so there will be pages and pages and pages of representations and warranties, often the longest part of the agreement.
Right.
And unfortunately, as a seller, you need to make sure that every sentence is true. The reason is that there will be another section that comes later that will be an indemnification section that says if the buyer is harmed in any way, harmed meaning loses money, and that doesn't mean that necessarily that they're sued by someone, but it could be any kind of loss of value due to some representation or warranty being untrue, then you as the seller are going to have to cough up and give money back. As Mittal said towards the beginning, how much of the money that you're getting, how much of that top line number do you get to keep and how much can be clawed back? And one of the main ways money gets clawed back is because there's a representation or warranty that's untrue.
I'll give you an example that we usually look out for. So let's say there's a rep that says, because we work in the tech industry, so we have clients that are all over the world. One rep says we are GDPR compliant, or we comply with all privacy laws and regulations, something broad, and you don't disclose against it or you don't revise the rep. Then post closing, the buyer finally, looks under the hood and gets into everything and says, well, this is not compatible with our existing systems because this subsidiary, their product, their customers, they're not GDPR compliant. And so we need to expend, $100,000 fixing this and fixing all the violations and making them GDPR compliant. That's not a third-party lawsuit. That's not, post-closing, someone's coming and suing them. That's just the buyer deciding that now they have to clean something up that was as a result of a pre-closing issue. They'll look to the reps and warranties, they'll see that this is actually a rep that was violated in breach. And, we'll take that out of the purchase price. We'll claw back, take it out of escrow, whatever. Obviously, if you're our counsel, if you're our client, we wouldn't let that happen. We would revise that provision, and or we would carve out non-third-party claims. But sorry, David, I didn't mean to interrupt you. But that's one example of why reps and warranties are important and how they interact with indemnification, even outside of third-party claims.
True.
So, in the professional services context, you're going to be asked about things like the quality of your receivables, about the stability of your client base, the manner in which you do your work, the lack of any malpractice claims, and small tweaks can make a big difference in terms of what you're actually representing. And so it's just important that you really are walked through every sentence. It can be painful. It takes a few hours, and chances are some of them are not going to be true. And you can disclose against them. There's things that can be done, but you don't want any of them to be false. But equally important to that, so you'll have 25 pages of reps and warranties in this agreement, right? What you as a seller will want, once that's all said and done, is some provision in this agreement that says, okay, we'll agree to these 25 pages of reps and warranties, but you, buyer, the only thing you are relying on in doing this deal is that 25 pages of reps and warranties. You can't come back later and say, well, in some conversation on January 3rd, you told me XYZ, or in this email, you said blah, blah. It's really important. Just as important it is to make sure the reps and warranties are true and you can stand behind them. It's making sure that the buyer is stuck with those things. And that's a point of negotiation that it's one of those things I'll say, when you're looking at a purchase agreement, just like when you're looking at an LOI, it's not only important to make sure to revise what's in there, it's also to make sure to add what's not in there.
And I like what you just said, because that's very important. Like you said, that maybe something that was discussed in some email during some day, or maybe on a call, maybe something, a passing comment, whatever it may have been. But because I've seen, that sometimes, there are some terms in the agreement which is kind of like everything that we have talked about until this moment, you agree that was correct. And that could have been anything.
It could have been anything.
That can be difficult, very difficult to hold to. And I guess, very interesting thing that you're bringing out is that, and I think this is something for all the listeners to know, is that after you sign the agreement, you're not off the hook, right? The money may come to your account and you're like, all right, now you're thinking about the next stage of your life, golfing, whatever, but you're not off the hook because you spoke about something called the indemnification clause. Right. So what is that provision? What is an indemnification provision, and how should sellers think about their exposure when they're looking into this provision?
So the indemnification provision generally says that you as a seller are on the hook for certain losses that the buyer suffers in connection with the deal. The most common of those are the reps and warranties being untrue. But there's other types of things that one indemnifies for oftentimes. If it's an asset sale, for example, the buyer purchases assets but not liabilities. So any liability that's not assumed, the seller has to indemnify for. That's just an example. And broadly speaking, indemnification falls into kind of two buckets. There's third-party claims, like buyer getting sued because there was some malpractice pre-closing, of the example. And then there's the kind of thing that Mitchell was talking about with the GDPR example, just direct losses, like, hey, you said you were compliant with GDPR. And by the way, this is something that could be a rep for sure for an accounting firm.
Yes,
If you don't operate internationally, no, but compliance with privacy laws for sure. Um,
absolutely.
if the buyer says, if you rep something and it's not true with respect to your compliance with laws, for example, and the
Yeah.
buyer has to remedy it by changing systems, whatever, they can sue the seller for indemnification over that. Um, so when you're talking about indemnification, obviously the first thing is what you're indemnifying for, but then the other thing is, how much. That's very negotiable. It's not necessarily the case that you're on the hook for all of these losses. There are caps. There are different caps for different things. There's
Yes.
time frames. These are all negotiable things that you need to know are negotiable.
And you need to have a stomach for the negotiation. That's
Yeah.
the other thing. Going
Yeah.
back, I mean, this is full circle, but going back to our first point, these are people who are professionals at negotiating. This is as seller, your first time at negotiating. And so if you get on the phone with your counterpart, and they're gonna, first of all, they're gonna try to separate you from you and your lawyer. They're going to say, well, the lawyers kill deals, this is dragging too long, like you need to keep them in check, really. A handful of issues will percolate up to the CEO, and then they'll say, well, this, if anything to do with pre-closing, you guys should be on the hook. This is your thing. Like you have to indemnify us for all of it. Why are you even asking? Why are you even trying to cap your liability? Is there something going on that I should know about? Like kind of threatening to blow up the whole deal. Don't fall for that, because yes, as sellers, you're technically, supposed to be on the hook for any liability pre-closing. But as buyers, they get the benefit of any future gain post-closing. And so why, it's a negotiation, it's a risk allocation. Why should all of the risk fall on the sellers and all of the gain, future gain, fall on the buyers?
Very,
Take your
very well.
money and go golfing, right? Like
Yeah.
there should be some peace of mind that you at least get to keep 90% of it. And
Right.
Yeah.
if there's any post-closing, I mean, unless, we can qualify it, add knowledge qualifiers. Unless it's fraud or something you knew about, why should all risk post-closing fall on the sellers?
A very interesting question. And you talked about caps, David. I mean, like, I don't want you to, like, I'm not saying that this is the de facto standard,
Yeah.
but from the deals that you've seen, what's a typical cap number that you see for general apps or
For
whatever?
yeah, for most things, general reps would be the way we would talk about the normal things that are capped. So 12 to 18 month time period for them to survive, 10 to 15% cap,
Mm-hmm.
uh, and then there might be an intermediate cap for certain important reps, and
Mm-hmm.
then 30 or 50% for certain things, and then other things would go to the entire purchase price.
Brilliant, brilliant.
Yeah.
We can continue to talk on this,
Yeah.
obviously, but I would want to like just shift the focus a little bit because, I know there's a lot for us to cover. We probably may not be able to cover it all, but, I want to make the best use of
Yeah.
both of you here, right? So, and you talked about it that, this is a very psychological event as well, So, on one side, you got maybe a established buyer or maybe a PE backed platform that has done this dozens of times.
It doesn't.
And
Yeah.
on the other side, you got a CPA firm, on a first time
Never
owner.
done.
I mean, an owner
Yeah.
who's built a business over I don't know, 20 years and is doing this once in a lifetime. It's a lifetime event. So, this is where, I guess most of the imbalance shows up. So, where do sellers typically get emotionally influenced in a way that really hurts them?
It's usually not at the LOI stage. Um,
Okay.
we we usually find it's in the middle, the late part of the middle of the process. Their diligence is largely complete, but the things that are left are the more troublesome things. It's the things that are being drilled down. You know, um, if there's a post closing element of the owners being part of the new entity in some sense.
Yeah.
The details of that are being negotiated. It's all getting very real. We're down to negotiating wise, um, a limited set of things, but those limited set of things are important. And the buyer will try to, as Mitchell said, they'll try to drive wedges. And that kind of this confluence of things are now, this has been going on for a while. We're down to consequential things. They see the money and they haven't done this before, so they don't really necessarily know who to trust. That and they want this to close. Like the easy path is to agree to whatever the buyer is asking for, and anything that will extend that is getting in the way. That's when things get more emotional.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now.
True. Absolutely. Now, there is this thing that, you often hear, especially that, this is standard,
Yeah.
you know, you hear that a lot. And like, this is standard, this is a standard that happens in almost every deal, and, and we are talking about red flags, and one of the red flags you kind of like put that out in a buyer behavior, like like if they're trying to create a wedge between you and your legal team, you probably want to be careful about that,
Yeah.
right? But and if so, would I be correct to assume that if you were to ever at any point of time hear these terms, which translates to this is standard, you should be just careful about it, like you should run that with your attorney or whoever it is.
Definitely. Yeah. You can't take the buyer's word for what's standard. If your counsel agrees with you, that's different. I mean, agrees with the buyer, that's different. But definitely run that by your lawyers, because we've done this many times. We know what's standard. We know you, we know your company. And we're not, our job is to close the deal too. We don't want to stand in the way of closing the deal. We just want to make sure that our clients are making informed decisions.
Absolutely. And
And
now
that,
we're going
that
to
oh, I was just gonna say the one thing about standard things that are standard don't necessarily mean they're fair. They don't necessarily mean they're right for you as a seller.
yeah.
And it doesn't mean to blindly accept them. Being informed is important. And standard doesn't mean that it won't come back and bite you later. That's the important thing to realize.
True. And look, for a platform firm, it could be a standard for them because like whoever is going to be coming in, they're going to be, it's kind of like a cookie cutter solution for them. Whoever comes in, this is the silos they're going to
Yeah.
put in, and this is how we're going to do it, and this is how we're going to roll up, improve their processes, EBITDA expansion, and then eventually exit in some time in the future. Their role is very set. But like you rightly said, every seller coming in, for each one of you, you are unique in yourself, and that's why that's very important. I've spoken about structures, and one word that is like so heavily floated around is earnouts. All right, I hear it a lot. Okay, it's a topic
Yeah.
that keeps coming up with every firm owner that I talk to. They sound great on the term sheet, but they can become a nightmare. So let's set the table. Because obviously I want everybody to be clear about what we mean here. What is an earnout, and how are they typically structured in professional service deals?
So earnouts happen when buyers and sellers can't agree to a top line number, right?
Right.
Earnouts are essentially additional consideration that comes to the seller if certain post-closing milestones are met. So you may be selling your company for 5 million at closing, but if that subsidiary continues to earn certain revenue thresholds, let's say, then you get an additional 2 million at the 12-month mark or the 24-month mark, or and there could be a schedule to it. But that's essentially what earnouts are. The reason why they can be problematic for sellers is, unlike how you've been running your business pre-closing, you don't have a lot of control post-closing to ensure that earnout is achievable. Um, Sometimes they're illusory, right? The seller doesn't expect to actually achieve it, and they don't really care. Great, then it doesn't really matter. But that's usually not the case. Usually, like you said, the top line number includes the earnout number, and that's what entices the sellers into selling.
Mhm.
But
And
you have
and this is where like the most disputes start to happen in an earnout structure.
post closing, yeah, that's where a lot of disputes happen.
Uh,
But as you need to understand the buyer's motivation, right? Do
yeah.
they actually want you to earn this earnout? And are they going to think about it? Are they going to help you achieve this earnout? Is it to their benefit? When you're
Okay.
evaluating at the term sheet stage whether this earnout is worth it or not.
Well, if I were to subtly put it, I think, the because you rightly said, you are no longer operating your business the way you want, because it's the buyer who is operating the business and they are calling the shots of how the business runs. So probably to be able to achieve that, the performance metrics that are set, maybe you may not be able to achieve them because you're no longer
Yeah.
in that decision making scene. uh, may or may not be, maybe there's
And that's why
some
it's so rife for dispute, right? Because you may have a certain understanding of what's going to happen post closing for
yes,
you to achieve that
yes,
earnout, but
yeah,
as David, says all the time, the documentation doesn't match with what your verbal conversations were, and you might not have. Well, there's two really categories when we're counsel advising on earnouts. There's two main categories that we want clients to focus on. One is the economics of it, and two, the control. So economics, what do you need post closing to achieve this earnout? What kind of budget do you need? What kind of staff? Make sure that that's negotiated in the purchase
nice,
agreement, that you will have XYZ budget, and you'll be able to do with it what you want. And two, you'll have control. You'll have control over your team. You'll have control to sell your product, if it's a product or service, and you'll have control to change it. I recently I went through this last January where the client was so focused on making sure that the buyer will continue to sell the product as is. And that was, that number one thing. I want to achieve this earnout, and I can achieve it if they just let me have my salespeople and the buyer agrees to continue to sell the product as is. And that's what was negotiated. But then with the use of Claude and coding, vibe coding, whatever they want to call it,
yeah,
the seller now realizes that they can actually improve on this product and make it much
oh,
much better, much easier. And the buyer just won't let them.
oh my god,
And he's like, I could get this earnout, I can get all, with the commission
yeah,
payment. It's very simple. They're just not letting me improve on the product. And that's not what we were focused on in last January. It was very much like sell the product as is. But
wow,
technically the buyer's not required to let him improve the product. And so that's becoming a problem and on its way to a potential dispute. So
wow,
try to retain control. Try to get, the budget, yeah, that's easy to negotiate for. But it's
yeah,
it's the soft things that you can't predict that leads to potential disputes.
so very
But
true.
that
Okay.
does go back to the words in the agreement really
Yeah.
matter. And there was recently a court case in Delaware over this where there was an earnout, and it was in that case a pharmaceutical type, or actually it wasn't pharmaceutical, it was a medical product.
Right.
And the earnout part of it was based on getting FDA approval of type X.
Right.
And that wasn't possible, it turned out, post closing. But they could get type Y approval, which would have the same meaning.
Yeah.
It's just a slightly different process. And the court's like, it said type X. You can't get type X, you don't get it. So you have to put in that contract what you want, because that's what will be looked at later.
Well, it's not. I guess that's why it said that the devil is in the details, right?
Yes.
Right. So, that is there's the earnout is one term that is
Yeah.
often floated out, but I'm glad that we've cleared that out. You brought out some very, very beautiful points over here. what you need to be careful about in an earnout, and very interesting examples. There's one more term that we hear about, holdbacks, right? That's another common term that I hear about.
Yeah.
How do those work?
So there can be different holdback. A holdback, generally speaking, is a portion of the proceeds of the deal don't get paid at closing to the seller. It might get put into escrow. It might just be literally held back by the buyer. Why would they do that? Well, indemnification is the most typical holdback. Um, we had talked earlier about like a 10 or 15% cap on general representation breaches for indemnification. Typically, the way that's carried out is the seller doesn't get that 10 to 15% for a year to 18 months. And that way the buyer doesn't have to like literally claw back money that's gone into the seller's pocket. Um, so at the end of the whatever period it is that those reps survive, which means they can go after you for those reps, then you get whatever money is left. But there can be holdback for all sorts of things. For example, oftentimes at closing, there are some financial details that can't be determined with certainty. So there's certain assumptions that are made at closing as to the financials of the company essentially at the closing date, and then there'll be a 3-month period for actual final financials to come into place, and then there'll be an adjustment to the purchase price that way. There can be a holdback for that. And that's something accountants are often the people brought in to deal with those disputes. So, the audience is probably more familiar with that.
Those holdbacks essentially function like escrow. The
Yeah.
only difference is they're not getting an escrow agent and paying those escrow fees. So it's really that kind of holdback is essentially just an escrow. There is another kind of holdback that we deal with in our practice, but that's individual specific. So let's say a founder or CEO is getting 30% of the deal proceeds, taking out escrow and holdback at the purchase price level. The actual amount that they're taking home, sometimes the buyer will ask them to hold that back and then subject it to like vesting, where if you stay with the company through transition, whether it's 1 year, 2 years, or even sometimes 4 years, then you can get those proceeds to you individually back. And then we want to be careful not to treat that as compensation income because it is tied to services. But
Absolutely. Now, there's so much more that I want to talk to you about, but obviously, we're almost approaching to the end. So I will just talk about one topic. It's a bit sensitive, but we'll just briefly touch it. And like I said, I mean, I want to talk about taxes and regulatory issues, not too much in detail. And I want to acknowledge that's when something funny, like our audience is CPAs, they know taxes.
Yeah.
But knowing taxes and knowing how your own deal will be taxed are two different things. So, if you were to just quickly cover this, what are the tax surprises that you have seen sellers face post-transaction?
I think the biggest one, I mean, I don't want to say tax surprises post-transaction because, and I mean this very genuinely, we are super careful to make sure that at every phase there are tax advisors with their eyes on the deal. But the big thing that gets to be an issue is what Mittal essentially was talking about, which is what aspects of post-closing consideration. So not the stuff that comes at closing, there's usually pretty good certainty on. It's anything after, whether it be earnouts or holdbacks of the type Mittal was talking about, making sure that gets, to the extent possible, look, the tax laws are the tax laws, but to the extent possible that they're not taxed as ordinary income. And what does happen, that's a surprise in a sense, is at the LOI stage, maybe there was discussions of these contingent consideration, I'll call it post-closing consideration, being dealt with one way, and then it changes in the actual deal negotiations after the LOI, and those changes could impact the way that consideration is taxed. So that's the part that I think is most you need to be kind of most careful about, because little changes can really impact how a lot of money could get taxed later.
Yeah, you have to have a meeting of the minds between the buyers and the sellers that this is going to be reported in
Yeah.
the same way, right? Because if the buyer is envisioning giving you RSUs or some sort of rollover equity, and they need to, for their own tax reasons, treat that as comp, then the sellers are screwed because now they've taken a certain portion of their sale proceeds and turned it into comp.
Yeah.
That's a nasty surprise.
It is a nasty surprise. I could definitely talk to you on this. And all right, we just want the our listeners. There could I know that there could be a lot of listeners that are thinking about a sale 2, 3, or maybe 5 years from now, right? Uh, you know, and this is actually the best time to have this conversation. So if a CPA firm owner is actually 2 to 3 years out from selling, what should they start doing now from a legal perspective?
Make sure to get a list of from a lawyer, from someone, of the types of things that a buyer is going to look at in diligence and ask you to represent in a deal.
Yeah.
And 2 to 3, 5 years in advance is the time to clean those things up.
Yeah.
Make sure that you have proper procedures for what you do in place. I'm not so worried about financials and how they're being kept with an accounting firm, but make sure to be diligence ready, not to facilitate a deal, but to remove the potential liabilities that you would have that would sour a deal or end up having money taken away from you.
Yeah. If there was
All
a
right.
former partner that's disgruntled, get a release.
Yeah.
Get it now before they have leverage right before.
Yeah.
True. All right. Now we're going to be wrapping this up. Now I usually like to, have a rapid fire segment, which is like short, sharp answers. There is no right or wrong answers here, but whatever comes to your mind. All right.
Okay.
So, starting with Mittal, one legal myth CPA firm owners believe about selling.
I'm sorry, I didn't get that question.
The question is one legal myth
Oh, myth.
CPA firm owners believe about selling.
That it'll be quick.
Nice. David, same question. One legal myth.
That would have been mine. But that you're just going to get a check or a wire when it's over and you're kind of out of it. That's not usually the way it works.
All right. Mittal, one mistake that costs sellers the most money.
Not having your lawyers look at your LOI before you sell.
Nice. All right, David, one thing sellers should never agree to without their attorney reviewing it first.
That's everything. But what is the one thing? I mean, it's the LOI. Everyone's going to have a lawyer look at the purchase agreement. It's the LOI. You want your lawyer to mark up that LOI and get as much negotiation done at the outset.
All right.
While you have the leverage.
All right. And the last one is fairly simple. What's the best way for our listeners to find out about you and reach you?
Grellas.com, GRELLAS. You can find us. I'm at Grellas.com, and David is dsiegel at Grellas.com.
Well, there you have it, folks. That's, I'm obviously going to be, having this information, at least the website and the LinkedIn's available in the show notes. But the email address, you probably have to rewind this to listen to it one more time. So I'm not going to put that
It's
out.
on the website.
It's on the website as well. There you go. So that's a wrap for this episode. Mittal, David, thank you so much for your time today. This has been a
it was fun.
Yeah, it's fun. Thanks for having us.
Yeah, absolutely. And that's why I was looking forward to this podcast, because I knew that this is exactly how it's going to be, and it's turned out just that way. Sharp, practical, no fluff. So to all our listeners, if you are a firm owner that's thinking about a transaction, I would say that, go back and listen to this podcast maybe 2 or 3 times. The legal structure of your deal will determine your outcome more than almost anything else. So if you found value in this episode, share it with a colleague, leave us a review, subscribe whenever you listen. And with that, I thank you all for joining in. Until next time, take care and keep innovating in everything that you do. Cheers.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now.